Okay, any questions? I hit record. I did a webinar a month ago with some marketing teams, and I got through the end and I realized I never hit record. I won't make that mistake again. So anyway, so all right, good deal. Well, thanks for your time, everybody. Appreciate that. We'll record it, and I can send it over to MVCA also, Michael, if they want to do something with it. And,
sure, appreciate that.
And try to get that pushed out. R's done a great job with just trying to keep up with the times and keep in front of people. So I commend him on that.
Yeah, he's had some really good content for his webinar series and good participation. So
yeah, definitely. So yeah, all good. So all right. Well, we've got a nice slide there and some good questions.
I'm doing a poll too. Doing a quick poll after the introductions. So.
Yeah, Michael, you might want to scoot a little closer to the microphone. You sound just a little muted, or maybe turn up your speaker for what that's worth. So, all right.
Okay now?
Yeah, it's a little better. Yeah, thanks. So when I hit broadcast at 11:30, Michael, you can start talking, and then I'll start seeing the participants roll in.
Okay.
And then I'll say something like, Michael, we're ready to go. Then that's your cue to really start.
Okay.
So. Oh, I gotta turn off Outlook so it stops sending me reminders. Nothing like getting reminders when you're in the middle of a webinar. Teams meeting, people trying to call you, a Zoom call coming.
Yeah.
No, stop that madness.
Especially when you share screen.
Yeah, it's like, oh, I didn't want that to happen. So, okay, Mike, we're at 11:30. I'm gonna hit broadcast.
Okay.
And this will allow, normally when half of the people or so, whatever, get in, I normally start going. So, all right, we are now broadcasting at 11:30.
Morning, everyone. This is Mike from Fishman Stewart. Today we're doing our webinar on technology valuation, the impact of COVID-19. There's been a lot going on in the last number of months, and so we're trying to do a number of oversights and recaps on what's going on with technology valuation. And here today, we have a group of Efrat Kasznik of Foresight Valuation Group. And we have Doug LaLone of Fishman Stewart. He's an intellectual property attorney. Michael Gross of Beringea, and he's a managing director there. And we're going to go through various topics today, but we thought it would be a fun way to kind of kick it off with a survey to get kind of people's blood pumping a little bit and get a little bit of insights on our audience here. Okay, I'll read the survey questions. The first question is, why is technology valuable to your company? We have a number of multiple choice questions there being. A is company value. B is revenue generation. C is conflict avoidance, risk reduction. D is strategic to business products or relationships. And there's another box. The second one is of that component of the value of your company, what are the value drivers underneath that? Is it typically technology innovation? We have a lot of stuff going on with data in the industry now. Is that what's driving the value company? Is it brands, supply chain, or again, other? If you fall into that other category in a lot of these, I encourage you to reach out to any of these panelists and we'll follow up. And we'd love to understand some of those other categories. And the last one of these is, what is your estimated recovery timeline for your company? And it could be already recovered the next 6 months, a year, 18 months, or 2 or more years. So if you could submit your responses to those, it's anonymous, and then we'll actually display the results so everyone can enjoy those.
Hey, Mike, we're about 50% through the voting right now. We'll give it maybe a few more seconds, then we'll hit in polling. Then we can broadcast the results for everyone to see. Okay, we're about 70%. So here are the results.
Okay.
Wow.
And for question number one, we have the largest category being revenue generation, followed by company value, followed by strategic to business, products, relationships, and other. Number two, what's the largest value driver for the company? And it is technology innovation, followed by a pretty equal split of the others, except for nobody cares about the supply chain. And what's your estimated recovery timeline? A good, I think, optimistic 6 months is the winner there, and then year. And already recover. Hey, people seem to be at least 44% between 1 year and already recovered. So within the next year, a lot of people look to be in pretty good shape, which we don't like to hear that. Okay. In terms of kind of digging into the meat of today, we've all seen the impacts of what's going on in recent times. We do have COVID-19 in the title, but that's really more representative of current times. So the goal of today's webinar is to get our arms around what's happening with technology, what's happening with its value, and most importantly, what do we do about it? What are some takeaways that we can use to benefit ourselves professionally and our businesses, and how do we help the overall situation moving forward? So if, Doug, if you mind presenting that, the chart we have, the graph. All right, here's a snapshot. You know, everybody kind of feels things shifting, but here's a very recent snapshot of what's going on in the market. And I will not do this injustice by trying to characterize what's going on here. From intellectual property attorney point of view, I see a huge dip. I see stuff going up in a bunch of colors. But Michael Gross is ready to dissect this. And yeah, Michael, we'd appreciate your insights on this.
Sure. Thanks, Michael. And I think this is an interesting graphic to show kind of the point in time that we're at today. When we look at traditional valuation metrics for technology companies, they're either the same or better than they were going into COVID. So public equity multiples are actually up because, as you can see from the green and gray bars, the public equity prices have pre-COVID levels, but earning estimates are largely down across the market, although for some technology companies, they've actually increased. So traditional valuation metrics are intact. Interest rates are extremely low, which is another valuation input that drives higher valuations. And so from the pure science of valuation, at this point in time, they've held quite steady. Where we see a lot of impact for companies across our portfolio or new companies we're looking at is really the qualitative side of valuation. So how has the current environment, either the pandemic or the economic dislocation, affected your specific company? And then more importantly, how are investors or buyers of your company going to change the inputs to their model when they do the valuation? So while the overall ingredients for valuation have stayed robust, the lens that investors use to value that company may be more conservative, which would drive valuations down. For example, we look at time horizon that we're going to hold a company or an asset. And the more you extend that time horizon and you extend the horizon needed to achieve your outcome, the lower the valuation, because you have to discount those results over a longer period of time. Also, as investors, we often get projections from a company, and we'll sensitize those. We'll look at a number of cases. And I'd say in the current environment, investors are probably sensitizing down a little bit more to reflect the uncertainty of the next 6 to 12 months. And also just to reflect the fact that there's economic headwinds out there. So all of those things can impact valuation negatively, as well as just the environment of having fewer bidders. So investors are retrenching, spending time on their portfolios and maybe not as much time on new deals, although I think most investors are still looking for new transactions. But having them spending more time on their current portfolios and not new deals might decrease the buyer universe or bidder universe, which could have a negative impact on valuations. So all things considered, I'd say, given what we've been through with the pandemic and the economic headwinds, valuations are in a pretty darn good spot. And certainly if you're in one of the technology subsectors that can benefit from the new normal, valuations are oftentimes increased. And it's interesting to look at the graphic because it shows that bifurcation between more traditional businesses that would be reflected in the Dow versus the NASDAQ and SaaS index, which would reflect more high technology companies. And you can see as public equities have rebounded, more money is flowing into those tech stories who might be more insulated from the economic headwinds.
Okay. Michael, would you, I apologize for not doing this, would you give a brief kind of intro to yourself in terms of your background and all that?
Sure, I saw you wanted to get right into the meat of it, so we skipped over that.
I'm excited by the chart, I'm sorry.
Yeah, tells it. So yeah, real quick, I'm a managing director at Beringea, also the chairman of the board of directors of the Michigan Venture Capital Association. At Beringea, we're a growth equity investor. So we're focused mostly on stage and companies that are scaling commercially versus any specific industry. So we'll invest across industries, and we do a lot of high tech investing since we're doing growth equity investing. We have offices in Farmington Hills, Michigan, and London, England, and about 700 million in capital under management currently. So we're looking to invest in minority positions in privately held growth companies, often with a syndicate of other investors. Prior to Beringea, I worked as an investment banker doing M&A transactions and capital raises for middle market companies. And prior to that, I started my career at a valuation consulting firm doing economic damage models and business valuations. So for 2 decades, I've been valuing businesses with a number of different lenses across different industries with a significant focus on high tech.
Sounds great. Thank you, Michael. Efrat, can you kind of introduce yourself? You have a also very impressive background and tell us a little bit about what you do.
Thank you, Michael, and thank you for inviting me today. My name is Efrat Kasznik. I'm the founder and president of Foresight Valuation Group. We are an IP valuation and strategy consulting firm, as well as a startup advisory and litigation consulting firm. We're based in Silicon Valley. As you can see, I'm physically based at the Stanford campus, where I'm also teaching. I'm a lecturer at the Stanford Graduate School of Business. So what we do is value IP, as simple as it sounds, and not as simple always. We value all types of intellectual property as well as other intangible assets that may or may not have the legal protection. Doing anything from technology to brands to data. We're valuing a lot of data these days as well, something without formal protection at all. Across industries, so we do mostly tech, but also quite recently doing more and more of life sciences, as well as I mentioned, doing a lot of startup work. And one of our specialties at Foresight is the intersection between IP valuation and startup valuation. This is something that we spend a lot of time doing with our clients, as well as doing studies and things like that, and trying to kind of pinpoint where the two or our two specialties kind of meet and trying to understand that a little better. Yeah, so that's a little bit about myself.
Okay. Doug, can you do the same? Give us a little bit of highlight of your long career and kind of introduce yourself.
Sure, yeah. My name is Doug LaLone. I'm a patent attorney at Fishman Stewart. I've been practicing technology, IP, patent law for 29 years here in the Detroit market. My work kind of falls into three different buckets. It's identifying and securing the creative works for clients, that is working with the patent office and the trademark office and securing the IP. The second bucket is actually trying cases and resolving disputes for clients who get in trouble or who want to cause trouble with competitors. And then the third bucket is kind of what we're talking about here, strategic IP, looking at how to manage portfolios, looking at the value of technologies and how that drives value of a company so that you can move through the process to a successful exit where you're driving multiples. So thanks for having me here today, Michael.
Thanks, Doug. Quickly on myself, I'm also a patent attorney, do a wide range of whether it's filings, litigation, as well as we do a lot of strategic work. Long story short, how do you capture the IP and align it with revenue and offset risks? So how do you optimize intellectual property? It can be composed of very many different things, and how do you kind of leverage that to the company's benefit? And hopping back subject matter today, Efrat, do you have any additional observations on that the chart in terms of one thing I do want to appreciate in terms of is the distinction between company value and technology value. And my understanding is that this is reflecting a lot of what's going on with company values, but how does technology, how does the pure intellectual property, the intangible stuff fall into the big picture?
Yeah, so there's a common statistics in the IP valuation area, which otherwise has very little data, that is an index that has been measured by Ocean Tomo for many years that shows that about 85% of the value of the S&P 500 is composed of intangibles. Now, what does that mean? The correlation between IP valuation and company valuation is not as straightforward as we would like it to be. Part of the problem that we have is that on the balance sheet, if you know anything about accounting, and it doesn't have to be advanced accounting, you would know that your internally generated intangibles are actually not showing on the balance sheet. So to the extent that you want to look for the value of IP or some correlation of the value of your intangibles and the value of your company, looking at the balance sheet is not going to help you do that. So a lot of people turn to the stock market and they try to draw inferences, if you believe in the efficient market theory, that the entire value of the company's assets is reflected in the stock price. Somewhere therein lies the value of your intangible assets, or I'm going to use that interchangeably, but intangible assets is an accounting term. You only see it on balance sheets. Intellectual property is a legal term, and there's 4 types: trade secrets, trademarks, patents, and copyrights. And there's some correlation between them, although they're not entirely overlapping. So when you see something like that, if you believe the theory that 85% of the value of a company lies in their intangible assets, then you would think that the value of technology has dipped and then came up. I would argue that it's not exactly necessarily the case. I would argue 2 things. First of all, I would argue that the value of patents, and I saw that a lot of people in the audience are interested in the technology part of their intangibles. The value of patents, as I'm sure my 2 lawyer colleagues on the call would agree, is something that is going on a wild ride that has very little to do sometimes with the stock market at all. It has a lot to do with a lot of other things, like the Supreme Court decisions, the Alice decision, things like that, but not necessarily the stock market. So that's one thing. So if you look at the value of patents, and if I try to kind of overlay that, the value of patents has dipped many times in the past or in recent years. Some people would argue the value of patents is actually on the rise now, so it may not exactly be correlated with this slide. I would also like to mention the fact that it's very sectorial. So if you look at life sciences and you look at tech, these 2 segments of the technology industry, life sciences companies live and die by their patents, and they're also much more affected by the COVID situation than the tech companies. So you would see, if you look at the value of their technology, you would see an entirely different trend. Also depends on which sector of the life sciences market you are, than you would see here. So this is really company valuation, of which intangible valuation is a component, but does not necessarily always behave like that. Yeah, so I think one more thing I want to mention, and it goes along the line of what Michael Gross mentioned, is that what this is also showing to me, putting my startup cap on, is I see good exit potential here, because what I see is that the stock market is actually, and also knowing that there's been IPOs that are being filed, and also just seeing the fact that stock prices are going up, that means that buyers have more resources to buy. That means that VCs looking at investments are seeing an exit in the horizon. So this is good news for startups in general, IP or not, this kind of picture. So.
Yeah, and that's a great point. And I would say when we're looking at valuations over a 3 to 5 and sometimes longer year hold, we're thinking about the exit potential at the end of that. And so the fact that exit potential has held up even in this current environment, and when you look at the cash on the sidelines, we feel confident that once we get through this current dislocation, there's still going to be a robust exit potential, especially for technology companies, because you'll have legacy businesses that are looking to expand their technology portfolio, and also large, well-capitalized tech companies looking to increase the depth of their technology capabilities. And so we feel good about that exit horizon, which I agree is one of the main drivers for valuation. And to the capital availability piece, there's still $1.5 trillion of private equity capital on the sidelines. And so we can have some dips and peaks and valleys, but at the end of the day, and that private equity capital includes VC capital, at the end of the day, that capital will be put to work. And so that will be put to work in high quality companies. And so the high quality companies that are going to go to market over the next 12 months should still see significant demand because of that capital on the sidelines.
Yeah, thanks, Michael. Doug, in terms of from a protection standpoint, how is current times, how does it impact, how does protection impact technology, and kind of a follow-up, what is that doing with the company value?
Right. You know, there is actually a correlation between the technology value and the company value. So in this current state right now, we're seeing a lot of new technologies being developed. And so once someone like Efrat comes along and does the actual evaluation of the IP, then they're placing a value on the actual technology. And for example, the SaaS slide, the key example of a software product being created, which there are a lot of new software products. We're engaged in one right now. It's been very successful. We're on Zoom right now, which has a high valuation, right, Michael? We talked about that before we started this morning. So in the SaaS space, where people are innovating like crazy and the valuations are going up, you really have a couple different IP buckets to look at. You have the brands that they may be launching, like the Zoom brand, for example, that we're appreciating right now. You have trade secrets with the computer code that could be used as a tool to protect that bucket of IP. And probably more importantly, copyrights to protect the computer code as well. Patents are a tough one when it comes to software because of the Alice decision, like Efrat indicated. The Alice Supreme Court decision is making it tough to actually protect your software patents. It is possible. We've worked on cases as recently as this past a quarter where we've invalidated a couple software patents before the Court of Appeals of Federal Circuit down in DC, a case that Michael and I worked on. So the trend is probably not spending a lot of money on the patent side of things, but doing the fundamentals on protecting the software innovations using the copyrights and know-how, and then using a brand strategy to protect that. But how that equates then to a value of the company, if in a startup, if the key value is the technology, firstly, then probably second most value is going to be the human capital, right? The innovator. And often the innovator is the founder. So they kind of go hand in hand. So those two key individuals are the value drivers, I would say, in many startups. And so the valuation of both the human capital and then how well the IP has been defined and then protected on the back end, then allows people like Michael Gross then take that package of the technology being protected, and then the team behind it. They can take that to market and put an exit strategy of 5 or 6 years in place, so they can then build the team, move it, scale it, and then sell it. So I think the technology valuation and company valuation often go hand in hand.
All right, thanks, Doug. In terms of effort, what are in terms of as you're looking at various companies, technologies, what are the key value drivers, nuts and bolts of what's making a difference? And we're going to actually combine what do you recommend or what are your recommendations to maximize those? So nuts and bolts, what's making a difference, and what are some suggestions you think to help maximize the value as we move out into the next year, 18 months?
Mm-hmm. Okay, so I'll try and focus on kind of what how IP drives value, and then I'll let Michael speak to the fundamentals, kind of the more general multiples and things like that. So in terms of IP, you know, as I mentioned, it really depends on well, I'll speak about life sciences a little bit, and then about tech, and I don't know what the audience on the line here, but actually, I gave 2 webinars last week. One was life sciences and the other one was about brands. I actually would like to mention something about brands also. So as far as life sciences, in that industry, there's a little bit of more of a kind of a downward pressure on IP licensing at the moment, because of things like compulsory licensing and pressure from the governments around the world to, if you're kind of in the COVID zone of technology, you are kind of expected to to engage in very kind of friendly licensing, not enforce your rights vigorously, but kind of play nicely with everybody else, and so in some cases open up your entire patent portfolio for probing, looking for a compound that might be a COVID treatment. So in that particular sector, again, in that part of the sector, I would say there's a little bit of a downward pressure on licensing. My prediction for that is, as I told in the webinar I gave last year, as we know from the world of IP, as you guys might agree, the pendulum swings back. So the patent market is kind of a pendulum. If every time it goes a little higher, it comes down. There's lobbies in DC, and so I'm not concerned about the pharmaceutical industry. They'll be fine. Things that may look a little bit worrisome right now. I think just in general, if you're in life sciences, and again, you live and die by your patents, you should kind of follow carefully what's going on with patent pledges and things like that. But I think eventually things will be fine, and you just keep doing what you're doing, right? And a lot of that is science that takes many years. So that is a 3-month dip that's coming back. It's not going to impact anything you're doing. In the world of tech, as we mentioned, the patents and IP protection in general are not the traditional IP protections are not as critical. A lot of software companies derive value from their data. So data, and I know that Doug has some very words of wisdom on that. So I'm going to let him talk about best practices, but really making sure that the ownership to your data and the monetization of your data, you have an open path to that. Is at this point more important than having patents on your software, which you can't really get anyway. I also want to mention just one thing about brands, and that's an interesting type of IP that people don't always look at. I mean, people do look at, if you're in a B2C kind of direct to consumer, everything is brands. If you're Nike, if you're Disney, if you're one of these companies. But what we're seeing now with brands is we're seeing there's a lot of bankruptcies coming up, and that is a COVID impact. But what I think about COVID is that it's kind of the last straw for a lot of companies, like companies like Hertz. We could talk about Hertz, the Hertz bankruptcy. This is a 100+ year company that's going under, was in trouble because it was debt ridden anyways. So it was over leveraged, as we say, But at the end of the day, what's left at the bankruptcy situation is your intangible asset. So that's why I'm talking about that. So, and brand is a very strong intangible that you can find in a lot of either Chapter 11 reorganizations or pure bankruptcies, and also even patents. So I think that's an opportunity for people to look into, as well as something to think about as you build your company, to make sure that there's assets left at the end of the day. more for your investors than for yourself. But anyway, so that's a lot of things, but that's kind of some other commentary that I had on the situation and what to do in the future. Okay.
Thank you, Heather. Michael, we had prior to this, we had a great discussion on your thoughts on some of the value drivers. How does technology play into this? And then we're interested in kind of hearing considerations in terms, in light of those value drivers, what are some observations for the future?
Yeah, so as it relates to value drivers, when we're looking at companies, we're often looking at a category and saying, does this category matter to us, and does this category matter to the future? And so is it a space that we want to invest in? And then secondarily, is this the team and the company that can carve out a meaningful position in that space? And that's how we see value really being created. So circling back to Doug's point, the team is extremely important, and the team having credibility to execute, to become a player in that space is extremely important. And then where I think technology falls in is in the ability to protect that position they're carving out in that market, and also to accelerate their entrance into that market. So if a company has differentiated technology and IP, whether it's patent protected or not, that's going to give them a chance to really capture a segment or a portion of that significant market. And so that's kind of how we think about underwriting new investments. And when then you put the current environment lens on that, you look at how that category is held up in the current pandemic and economic headwinds, and how that category may be better positioned coming out of it or not. And so you see a lot of differentiation in how valuations have held up for the Hertzes of the world, and who are in the travel industry are highly impacted, versus telehealth companies, which have a massive increase in adoption and kind of a realization by the market that this is the way we should be doing it, pandemic or no pandemic. And it really highlights some of the efficiencies that can be gained. So that's kind of how we think about value drivers. When we think specifics, what companies can be doing during this environment to maintain value, we're looking at revenue streams of companies. And when you think about technology valuations today being as high as they are, you look at that SaaS index, they're probably trading at 10 times revenue. And the reason that those public equities are trading at 10 times revenue is the repeatability of that revenue stream and the ability to grow it. And so when you think about the current environment, anything that's a detriment to that repeatability will impair that value. And there's a broad range of valuations for tech companies and SaaS companies, anywhere from 2 to 3 times revenue to 15 to 20 times revenue. So it's a massive range, and where you fall in that range depends on how protected you are in your market and how you're protecting that revenue stream. So when we're advising our companies and looking at how to navigate through this environment, some of the tactics that they're using are taking some sales resources and redirecting them to customer support to try to reduce the level of churn as the economy is in this dislocation. Because if you can get through this type of environment with low churn, you've really proven that you've got a differentiated solution and a sticky revenue stream. And I think that will bolster your value coming out of the pandemic. So we're thinking a lot about different tactics like that to try to maintain your position.
All right, thanks, Michael. Doug, and we're probably entering the last 5 or 7 minutes of the webinar here. But Doug, how would you get into, in light of what Efrat said and Michael said, we have technology value, we have company, like how do we sustain long-term? How would you go about identifying, protecting, and leveraging those key value drivers to optimize value in the future?
Yeah, I think it's kind of a common recipe that's in our IP tackle box that we use. And I'm just going to play off of the SaaS chart that we had up there and just talk about software. So this is applicable to lots of different types of technologies, particularly e-commerce technology. So I'll kind of answer kind of in two points there. 2 key value drivers I see, which would be analogous in other areas where it could be brick and mortar or not, but specifically in the e-commerce space, or even in the telehealth, as Michael indicated, which is super hot, obviously. I would say the first thing we need to look at is to identify the business model and what's driving the revenue. So if it's a brand new technology, guess what? There's no revenue on the balance sheet to look at, right? But let's just say it's a company that it's a new technology and you think it's going to be driving revenue. Say it's a bolt on to an existing platform. Okay, let's just take that scenario. So in an example, say telehealth, where a new app has come up, for example, in Squawk Box this morning, the innovator of a ring, and he connects it, the ring sends bio information to your phone. I don't know if you saw Squawk Box this morning. It was a great conversation. It's now allowing people to consider the possibility of predictability of your health, then they correlate that to COVID-19 symptoms. How cool is that? So let's just play on that for a minute. There are two buckets of IP there, at least that pop out at me. One is the data coming in. Lots of data coming off of all these humans around the US are in this test situation who are volunteering, providing their nightly data as to how their body is performing. So data could be human data, could be machine data, could be data on how an engine is operating in a plant or on a jet engine or what have you. So trillions of bits of data are being generated every day. The question is, if you're in a company and you're creating data, do you own the data? Do you make sure that your agreements in place indicate what you can do with the data? Can you use it? Can you repackage it? Can you correlate it? Can you sell it? Because data is valuable. So the key thing there I just want to point out in the e-commerce type space, think about how the data is, what data is being generated. Make sure you own it so you can use it and leverage it. That's the first thing. And your agreements often cover that. And the second bucket in the SaaS space, then the simple buckets really are copyrights. Do you have your, do you own the software? Did the programmers that created the code, are they employees of your company or are they contractors? If they're a contractor, then under copyright statute, by law, the contractor owns it unless the contract in writing says something differently. And then you have a written agreement assigning it to the company later on. By contrast, if the software programmer is an employee of the company, then the company owns the copyright as a matter of law. So just two buckets. Make sure the data is taken care of because you're creating a lot of data in these new companies. And secondly, in the software kind of space, make sure the copyrights are protected. You own it and you register them, which is a separate step with the Copyright Office. So those are two kind of key takeaways I'd suggest kind of in the current environment of how the SaaS type of products should be protected.
Thanks, Doug. And really, it's kind of in wrapping this up, we have a really good audience question. Essentially, it boils down to how do we arrive at numbers? So, and I'll ask this kind of jointly to Efrat and Michael. Can you provide some insights on how do you come to a dollar number for whether you're looking at IP, you're looking at value of the management, execution ability, whether you're looking at the brand? I think at the base of the question is, how do you put a number value on things that have a lot of subjective factors to it?
Yeah, so I'll take that. And you know, it's valuation at the end of the day for companies that are emerging is really an art. But there's no easy way to value a company that is either pre-revenue or in that emerging growth stage. So from our perspective as a growth investor, at the end of the day, it boils down to a model. So we're going to pay X today, and we're going to execute over a 5-year period in the base case, and we're going to sell for Y. And so there are many different things that can affect the forecast and how you get to that exit value. And so for us, at the end of the day, it comes down to what is the future revenue stream of the company or technology in that market, and what is the value we expect an acquirer to pay 5 years in the future. And then we discount that back to today. And so the discount rate is then another big factor. And with very low interest rates, fortunately for companies, discount rates are pretty low because the price of risk has come down. But if you're very early and there's a lot of risk for you to enter that market and to grow to that exit point, we're going to increase the discount rate, and that will lower the value. If you've already broken through and you've got a great patent portfolio and great technology and clear line of sight to executing and winning market share, the discount rate's going to be much lower, especially if you've got a team who's been there and done that in the space. So it's a broad way of taking all of these ingredients and coming up with a model to say, if we layer a security onto this company or technology, what is that security worth?
Great. Yeah. Efrat, what are your thoughts on that?
Yeah, well, I could talk a lot about that, but I'll try and make it short. Let's talk about patents, because that question, the question of IP, I can talk about each different type of asset and for a long time. So let's talk about patents just quickly. And if you came to me to value your, let's say you're a startup. So let's put it in the context of raising funding, because there can be many contexts, which kind of makes the valuation of patents specifically more complicated. There's really two ways so the most important thing is understand the business model. So going back to Doug's comment. So with intellectual property, if you don't understand the business model, there can be many different values. The value to you as a startup is not the same value to Microsoft of the same patent, right? I think everybody understands that. When it comes to patents, there's two types of business model, really. One is enforcement. The other one is technology transfer. So you can either take your IP, the IP protection on you, which is what a patent is, on your technology, and use it to sue others who are infringing on your technology. That's not every patent is suitable for that. So me as an IP valuation expert, without getting into a legal assessment, so I'm working hand in hand with people who can give me that input, make the initial assessment, is this a candidate for enforcement, or is this a candidate for something that's future looking? Enforcement valuation is all about building a model of damages. That's what it is. So that means you're going to take your patent, you're going to start either trying to license it, or if in the case somebody's not willing to pay your license, take them to court. So that's a whole enforcement model. That's usually suitable if you have more than one patent, if it's an older patent, and if it reads on a massive market. So think about a mobile patent, for example, that you are lucky to file in 2010. But a lot of the startup patents are not these kind of patents unless they bought them in the market. So if you're starting today and filing something, it's usually forward-looking. And for that to have value, in and by itself as a patent is not enough. You need to have technology with it. So you have a whole package that you can then go out and license. Then you have two choices. You can either build the product, then again into the world of startups, and I can create a model of how would a company look like building a product around your IP. Or, as I usually recommend to people, you can actually license this package, and you don't have to deal with manufacturing in China, where you know nothing about, and you don't have to deal with distribution, which are the two things that stand between your idea and the market. Sales and manufacturing. If it's a device, if it's software, it's the same thing, just there's no manufacturing, but there's still selling. Selling is a big thing. So, so you can license your idea. To license your idea, again, depends on what industry you are, you usually need at least a developed technology. If it's software, let's say you need something that you can show, or if it's something else, and then you need the IP on that needs to kind of be sufficient for you to go and license it, and that gives the business model is completely different. Now it becomes a licensing model. One more thing I want to say about IP is that for a startup to think about is IP can have value outside of the company. So the nice thing about intellectual property is there's one value to you as a startup holding it, and there's a different value to the market. And when I look at IP for funding, I always try to get the higher value. Not that I try to inflate the number, I just try to show the potential to investors. Because if the company needs to pivot, let's say that their product doesn't work in the market, but they still have this intellectual property that they can then go and license to others, which is what they should be doing, then what is the value of that? And that value is not going to be part of the value of the company, because this company holding the IP right now cannot realize this value. So that's just another thing to think about for startups.
Thank you. As a quick observation, kind of to tee off of final words from Doug, I think a lot of the times the value comes into the specific buyer, the specific market, and what it's going to